So we had a very good bookings in this quarter. This quarter had the highest ever booking. We signed 27 transformational deals. So that's going to help us incrementally demonstrate better growth in the coming quarters.
Why is the guidance staying muted, or is it a case of HCL Tech not wanting to jump ahead of itself?
No, actually, I mean, a quarter back when we did the planning, we obviously had the pipeline for the full year. We had some view of the pipeline at least for the next 6 months, and some of this was already baked into our guidance. So, I mean, I think we're going to look at a couple of more quarters and see if there is a need to change anything.
If 50% of your growth has to come from organic and 50% from inorganic, obviously a lot of it is being pushed into the next 3 quarters, right? Because you haven't delivered on that front in the first quarter.
No, I think 2.7% constant currency growth if you were to equate it across 4 quarters, I think we'll be fine.
Now we come to you, Mr. Channa. Is there more pressure on you now as far as margins go, just simply looking at the deal pipeline, because the street is perhaps thinking that maybe the margins are lower from these deals, or maybe the pricing is lower?
So in terms of margins, the performance has been very good. Momentum is there, and if you this very interesting analysis which we have given for the first time this quarter
The
is
mode
1, mode 2 and mode 3 separate revenues and margins. And we are the only company which is reporting these revenues and margins in this manner. And if you look at the margins in mode 3 are 25% plus. If you can look at the margins in the digital services, which is mode 2, digital, cloud, IoT and security, cyber security, there the margin is slightly below the company level margin because it's in an investment phase. And mode 1, which is the traditional services, is in line with the company level margins. I think it's depicting the way the things are going to come. Mode 3, more stable stream of revenues, more predictable stream of revenues, annuity based revenues, giving better margins.
In fact, the stated vision of the company is that mode 2 and mode 3 has to start matching mode 1. We've seen it be a little north of 26% for the quarter under review. But when are you expecting to reach that equilibrium of 50%, 50%?
Not 50-50, but I think in the next 2 to 3 years, we want to get to 40% of our revenues from mode 2 and 3. And I think we are pretty much on track. Our strategy is working well.
That was